Hi there. My name is Victor Aluyi, and I'm the head of investment strategy at Sankore Global Investments. This is your weekly financial market update. We start off in the US where, the stock market edged lower on Friday as concerns around tariff and inflation essentially unsettled traders. The major benchmarks took a leg down as President Trump hinted at the fact that he was planning reciprocal tariffs on trading partners. And this would essentially imply that the US is then likely to raise tariffs across board, across a slew of countries, really, to be sort of commensurate or equal to the rates that these countries are charging the US. Again, it remains to be seen how things pan out on that front. But, that created a major, concern, in the market last week. And we saw on Friday, the Dow fell about 0.99%. The S&P was down 0.95, while the tech-heavy Nasdaq lost 1.36%. Friday's losses essentially left the three major indices in negative territory for the week. For the week, the Dow and the Nasdaq fell 0.5% each, while the S&P slid about a fifth of a percentage. And the week was really very volatile. Stocks started out the week lower on Monday after President Trump, over the preceding weekend, had essentially announced tariffs on China. He also proposed and then paused, a 25% tariff on Canada and Mexico. And in the aftermath of that pause, we saw the S&P rise for three consecutive sessions, really on the back of that, tariff, reprieve. And nevertheless, that was really not enough to pull the markets into positive territory, for the week. We also saw some data, particularly on the inflation front, like I highlighted earlier, that sort of created some, concerns, really. We saw consumer sentiment data for February, which came in weaker than expected. It came in at 67.8. The market was looking for about 71.3. The more concerning part of that report was the fact that, respondents were expecting inflation to hit 4.3% in a year's time. Now, this marks about a 1% rise from the previous estimate that had been taken, last month, and also the highest that we're essentially looking at since November of 2023. For the jobs reports that came out last week, also the U.S. economy added 143,000 jobs in January. This was lower than the 307K we had seen in December, and also lower than the 169K, that the market had expected. Also, the jobs reports revealed that unemployment dropped from 4.1 to 4%, and that also average hourly earnings had risen more than expected. So this, of course, sort of stoked some concerns, around inflation. Also on the earnings front, there were some, disappointments really from typically sturdy and non-disappointing, names really. Amazon guided to a weaker than expected, revenue growth. Also, Alphabet's somewhat disappointing results earlier on the week kind of fueled, some negative sentiment in the tech space, and this actually contributed to, dragging, the market down for last week. For this week, all eyes will really still be on that tariff situation, as President Trump has hinted the fact that he'll be announcing a 25% blanket tariff on steel and aluminum. Also, the data fronts will be quite busy, this week. CPI data is due on Wednesday, followed by initial jobless claims, and also we'll be seeing producer prices released on Thursday as well. As a matter of fact, Fed Chair Jerome Powell would be speaking to Congress, today. Again, markets will be looking to, get a sense of his own thoughts and how the Fed will be threading the interest rate path, going forward. I think in the near term, the market is really likely to remain nervy. That policy uncertainty essentially just continues to linger. And over in Europe, the BOE made its BOE, that's the Bank of England, made its first rate cut in 2025 amid, growing concerns about sluggish growth for the UK economy. It cut its benchmark rate by 25 basis points to 4.5%. And the governor, Andrew Bailey, hinted at the fact that we're likely to see more rate cuts this year, particularly as inflation was starting to come within range for them. It also halved its 2025 growth forecast from 1.5 to 0.75 percent. I think growth remains a really, really strong concern in the UK. The concern really around cutting rates to sort of refill or reflate that economy have been really around inflation. Now that the BOE estimates that inflation is sort of coming within range for them, then we're certainly likely to see even further rate cuts to try and support the flailing economy in the UK. Also, the Reserve Bank of England cuts its interest rate for the first time in almost 5 years. Slowing inflation again in India kind of offered some leeway, if you will, for the Reserve Bank to cut rates with the aim really to try and reflate that economy that's kind of started to slow. Overall, it expects GDP growth to come in at 6.7% for the next fiscal year, while inflation will be at 4.2%. In our local markets, the Treasury bills market opened the week on a sort of tepid note, really. Attention was really focused on the auction, the outcome of that auction, and what it would certainly be for the market. And certainly we saw a very strong auction, and we saw a strong bullish sentiment after the auction, basically as all of the on-field bids at that auction essentially filtered through to the secondary market, and that really drove yields down from about 20.32 to as low as 19.05 in the secondary market. We saw a really strong bullish move, in the T-bills markets, even right before the auction and after, the auction. At the auction, the DMO was offering about 670 billion across, the three maturities. It was oversubscribed about 2.5 trillion. It, however, sold what was exactly, on offer. Our stop rate remained the same at the 91 on 182-day papers. It was, however, significantly declined, by 150 basis points at the 1-year paper. The bond market, the week started out somewhat cautiously. However, we started to see very strong demand midweek as the market started to expect that the Treasury bill auction was going to be strong, and in the aftermath of the auction, we continue to see very bullish and strong moves, in the bond market. On average, yields declined by about 23%, 23 basis points, week on week. So for this week, we'll continue to monitor, events within the fixed income market. We're supposed to have, the MPC meeting coming up next week. However, the committee seems to have postponed that just on the back of the fact that inflation data, all of the rebasing, that data isn't out yet, and it's a major data point with which the committee typically, deliberates. So we'll basically continue to keep an eye out for that and see how things pan out on that front. While on the global front, I think the whole tariff situation is one that we'll basically continue to monitor, really, because it has very strong potentials to determine how the market moves, at least in the near term. That's pretty much it, for our market updates. We hope that you have a very, very productive week. Thank you very much for your time.